Good afternoon, everyone. Trust that you and your loved ones are safe during these difficult and different times. I'm Yasmin Omari, Executive Director of the Pearl Initiative, and I'd like to thank you for joining us today for our webinar on Gulf Business Beyond COVID-19, Shaping New Realities, the third in a series that we are holding in collaboration with the Global Compact Network UAE and the World Green Economy Organization. Before I delve into the theme for today's webinar, I'd like to take this opportunity to provide a brief overview of the Pearl Initiative for those of you that aren't familiar with the organization. Developed in cooperation with the United Nations Office of Partnerships, the Pearl Initiative was launched in September 2010 at the United Nations headquarters in New York. The Pearl Initiative is the region's leading independent non-profit organization committed to supporting the private sector to proactively take a lead in adopting higher standards of corporate governance, accountability and transparency in order to enhance business competitiveness and value creation. With its growing network of partner companies, the Pearl Initiative is committed to driving collective action, exhibiting decisive leadership and sharing of knowledge and experience to positively influence regional businesses and student communities. About today's webinar, harrowing statistics and facts from the world scientists are demonstrating that human impacts on the natural world are causing more degradation than previously expected. As consumers demand increasing accountability from corporations, companies need to reinvent how they approach sustainability in the environmental, social and governance agenda. This is of particular importance as the recent COVID-19 pandemic is being associated with environmental degradation and the overexploitation of natural resources, both of which are linked to financial outcomes. So what can companies do to embed new and innovative approaches to ESG factors and take a new stand when it comes to their sustainability? In a conversation today with leading Gulf business representatives, this panel will evaluate the past ESG trends for companies across the Gulf, map out the current sustainability needs and examine how Gulf companies can be part of the solution, examine how sustainable finance can be utilized and implemented for positive outcomes, and offer solutions for companies to try new sustainability strategies to facilitate impactful change. I am pleased to introduce our expert moderator and panelists for today who represent a wide range of Gulf organizations. Our moderator today is Jessica Robinson, Associate Director in International Affairs with Abu Dhabi Global Markets. Jessica is a sustainable finance and responsible investments expert, working as a strategic advisor and consultant to institutional investors, think tanks and governments in these areas. Jessica has an extensive background in professional services and business consulting, focusing on financial services, environmental finance and sustainability industries. Our panelists today are Ahmed Hafiz Abdulaziz, Financial Sector Specialist, World Bank Group, Inclusive Growth and Sustainable Finance Hub. Debasis Day, Partner White & Case LLC, and Tushar Singhvi, Director at Crescent Enterprise CE Ventures Crescent Enterprises. Ahmed Hafiz Abdulaziz is a financial sector specialist with the World Bank Group, Inclusive Growth and Sustainable Finance Hub in Malaysia. Mr. Abdulaziz brings with him 10 years of relevant experiences in financial sector development, particularly in the area of Islamic capital markets, Islamic social finance, green and sustainable finance, and financial inclusion. He has worked as a Principal Assistant Director at the Ministry of International Trade and Industry and as a Manager of the Islamic capital markets at the Securities Commission in Malaysia. Debashis Day is a partner in White & Case LLC's Global Capital Markets Practice and Global Head of Islamic Finance based in London and Dubai. He is also a member of White & Case's Global Sustainable Finance Practice. He has extensive experience in structuring complex infrastructure and non-recourse finance transactions in the conventional bond market and the green and sustainable finance and Islamic finance markets. Final panelist for today is Tushar Singhvi. He leads the corporate development and investments activities and is responsible for evaluating and executing new investment opportunities on behalf of Crescent Enterprises. He also manages the portfolio companies through strategy and corporate development. He has been instrumental in cultivating corporate prospects and in contributing to the development of Crescent Enterprises' strategic and operational plans within the ports and logistics, business aviation, healthcare, private equity, and venture capital verticals. Once again, thank you all for your time and support in delivering this webinar today. Today's session is set up to be a conversation between the moderator and panelists, and we will set aside 15 minutes at the end of the discussion for questions from yourselves as webinar participants. As with all our webinars, we do like them to be as interactive as possible, and we invite you to ask any questions you may have pertaining to the topic during the session using the platform's Q&A tool, and the panelists will take the last 15 minutes of the session to answer them. I will now hand over to Rachel Paneno, who will give you a brief overview of the UN Global Compact local network in the UAE, as well as the World Green Economy Organization, our partners supporting the delivery of this panel here today. Thanks all for joining, and I hope you enjoyed today's session. Over to you, Rachel.
Thank you, Yasmin, for the introduction. Before we start the discussion, I would just like to say a few words around the World Green Economy Organization and the Global Compact Network in the UAE. The World Green Economy Organization is a multi-stakeholder organization consisting of platform members from cities, public sector, authorities, private and financial sector companies, academic institutions, and youth programs, all of which are engaged in green economy-related practices, activities, and issues. The organization seeks to promote the widespread acceptance and increased importance of green economy in the context of sustainable development and poverty eradication, and intends to support emerging global actions towards the green, low-carbon, climate-resilient development model. The organization is framed to operationalize green economy concepts on the ground through results and impact-oriented action. As part of the World Green Economy Organization, the Global Compact Network UAE is hosted by the organization. The local network aims to mobilize the UAE's private sector to align both the UN Global Compact's 10 principles and the SDGs through various programs, task forces, and activities in relation to key priority areas. Facilitating the collaboration and communication between businesses and non-businesses, the local network looks to provide a platform for dialogue to occur. I hope you enjoy the upcoming session, and I would like to now hand over to Jessica to kickstart and have a good discussion. Thank you so much.
Thank you, Rachel. So before we move into the discussion with the panel, I'm just going to take a few minutes to really set the scene. I mean, for myself, I've been in the sustainable finance industry for close to 15 years, so I guess that makes me quite an old timer. And I've worked across different markets, worked with governments, institutional investors, regulators, and I've seen a lot of change. But nothing really like what's been happening on the international scene for the last couple of years. We are definitely seeing a movement from a sort of niche discussion to mainstream, where sustainable finance is sitting at the core of a lot of what financial institutions, governments and regulators are talking about. And really sustainable finance is in my view, about moving capital into green, clean, fair businesses and industries. It's really, how do we use our financial markets to drive capital at scale towards a sustainable future? And a part of that, we obviously hear a lot about ESG, and this is really representing an investment discipline and a process that considers both environmental, social and corporate governance criteria to generate long-term competitive financial returns as well as positive societal impact. So obviously on the E, the environment, we're talking about the impact a company has on the world around us, the resources that it needs to sustain it, and obviously that can be fairly broad, anywhere through from sort of greenhouse gas emissions to the potential climate solutions a company or a business may provide, energy efficiency, biodiversity and so forth. Social, we're looking at the company's role in society, so labor standards, how a company treats suppliers, local communities and so forth. And of course, more mundane matters such as health and safety management. And then on the governance side, the rules and the principles that really sit around and determine the relationship between management of that company and the various stakeholders. So why are we seeing such a rapid growth in the last couple of years, certainly internationally? And I think in part this is due to the recognition that non-financial issues do play a critical role, both in good risk management, but also in value creation. And I think we'll explore some of this in our panel discussion. But there's obviously been moves on the regulatory side around company disclosure, as well within the financial markets, where we're seeing regulatory frameworks to actually support capital growth into sustainable finance products and services. And at the same time, we're seeing demand growth from large institutional investors, the pension funds, particularly, you know, in Europe as well, the sovereign wealth funds and insurers. But we're also actually seeing an increased demand at the retail level, which is obviously quite a new trend as well. In terms of regionally, I think it's probably fair to say, and our panelists will give their view on this, we've been a little bit behind the curve, but I do think this is changing. And I think, you know, we're seeing increased demand from family offices and also the positive work from many of the regulators in the region. For example, here in the UAE, the regulators are working together to really build the ecosystem, bring partners together, educate and spread knowledge. And also we're seeing regional companies begin to take a lead on ESG practices. Now, just before we move into discussion, the sort of what's happening in terms of the COVID, the pandemic, and how is that impacting on the ESG and sustainable finance discussion. And there's just a few key issues that I would like to highlight, certainly from my perspective, seeing this, having worked, you know, in the field for quite a long time. I think the pandemic does have significant implications for ESG. I think very much so. We've seen it's brought to light some of the materiality of these ESG related risks, and also the deep linkages between businesses and their stakeholders across these value chains. And I think, interestingly, obviously in the short term, investors have been very concerned around the social risks, because those are the most acute factors right now, particularly health and safety and workforce dynamics. But it's also really highlighting the importance of governance. And when we look at companies, when we look at what's happened in the last 6 months, very much so the ESG leaders have been more resilient in the downturn. I mean, it's still easy to say, but the data and evidence is coming out. For example, Morningstar reported that the performance of equity funds, 2/3 of sustainable funds outperformed their average peers in the sell-off earlier this year. So I think that's really demonstrating what's happened. The other thing, I think there's a lesson to be learned in terms of climate change. You know, the economic downturn, and as Yasmin has mentioned, you know, the impact on environmental degradation. Obviously, with the economic downturn, global emissions are down, but we do know these are going to rebound once we start the economic recovery pathway, as it did after the global crisis. But I think what the pandemic really teaches us is that there are black swan events that can be quite unpredictable of where and when they occur, and climate change and climate impact events are similarly unpredictable. So from the sort of investor and the corporate perspective, there's a huge lesson in what we're seeing through the pandemic, and how we can better prepare ourselves and really understand sort of the environmental and health crisis and how this fills into the market crisis. You know, droughts, crop failures, floods and storms, they all create shocks that are similar to COVID-19. They're sudden, they're seasonal, and they can be dramatically experienced at a localized level. On the good news, what we are seeing is that as governments, central banks, and the industry moves forward to look at the economic recovery, sustainability is being placed at the core of that. You know, Europe has very much taken a lead on this, staying committed to the Green Deal. Whilst we're all focused on sort of protecting the lives and livelihoods, we're actually now thinking about how do we rebuild better. And it's really important that we see sustainability at the core of that. Interestingly, I actually think, you know, when the pandemic first hit, a lot of us in the industry thought this was going to be bad news for sustainable finance, because it would distract and it would go lower down the agenda in terms of priority. But actually, we're seeing big investors coming out and really urging companies to maintain their focus, particularly on reducing carbon emissions. So the good news out of that is, you know, it's great to see that we are still paying very clear attention to it. And I think also one of the discussions is around clean energy. We have an opportunity with the oil price cap crash to really think about how we invest more in clean energy. And obviously, from the investor perspective, renewables are really offering a price and earning stability that's actually quite welcome in this current environment. So that's me just really setting the scene, so we have an understanding of what we're talking about. I'm now going to turn to each of the panelists, really to provide a very high level perspective. What does ESG mean to you and sustainable finance, both in your current role, but in your business and your organization? And perhaps, Tushar, could I turn to you first on this question?
Sure, thank you so much, and it's a pleasure to be here. So I think that was a great overview in setting the context. ESG, as you've noted, has seen a paradigm shift over the last few years, becoming more prominent and more mainstream. I think fundamentally that's driven by, of course, the enhanced environmental and social challenges the world is facing, but awareness amongst people, amongst consumers making conscious decisions into what they buy, what they consume, the products, the companies they associate themselves with. And that, of course, drives a shift in strategic priorities and a change in the operating playbook of companies, where it's, you know, ESG is not merely an augmentation to business. It is a fundamental way of doing business. And hence, it's a critical driver to sustained overperformance over the long term. So it is absolutely critical, and you're seeing hence the stakeholders of every business, be it the consumers, be it shareholders, employees, everyone actually paying more attention to ESG and hence integrating ESG principles and sustainability principles into business. At present, we have been, sustainability is at the core of what we do. We've woven it into our operational fabric across our businesses. We are a diversified business group. We operate across 4 platforms. We have CE Operates, which is our operating business platform, where we operate in sectors like ports and logistics, power and engineering, healthcare, business aviation. So across those businesses, sustainability and ESG is actually woven into the way we do business. Across our investment platforms, we have one later stage investment platform called CE Invest, where we're investing predominantly in private equity, but in structured finance as well. We have a corporate venture capital platform called CE Ventures. Across these ESG, what was a few years ago a negative screening is now really integrated into our evaluation of investments and actual metrics to evaluate investments. And then we have our 4th platform, CE Creates, which is our in-house incubator. And that is essentially incubating businesses which have a very clear and defined purpose and social impact. So it is actually building businesses from the outset which have a very clear and defined social purpose. So across our businesses, we have integrated ESG and measure it on a periodic basis. We have been publishing sustainability reports for the last 8 years, and that has obviously evolved over time. But I think data is critical to actually enhancing an ESG framework across the board, and data is critical to improving processes. And that, I believe, data has also, in essence, accelerated finance and sustainable finance and the quantum of capital that's going into this space over the last few years. And I can more on that later.
Thank you. It's interesting, the point you made about negative screening. Sort of 5 years ago, if you were an investor who was negative screening, you would almost say that makes a sustainable investor, but that's no longer the case now. We're expecting much more in terms of positive screening, thematic investments, and so forth. Debashis, can I turn to you now to give another sort of private sector perspective, because I know you're closely involved in structuring of some of these financial transactions.
Thank you. Good morning or good afternoon, everyone. This is an interesting area because I would say that for the several years I've been involved in it, the question that has been asked over and over again is, what does it really matter? And that, inevitably in any discussion, either with an issuer or an arranger or people who were commenting on it, they would always ask me, but I see that there are these requirements which add a burden on, say, a company to adhere to, but you can never prove to me that there's actually some monetary gain from it. Is my cost of raising funds cheaper? Is my stock price going to be, helped or assisted in some way by the fact that I adhere to these principles or these criteria? What's the point? And it's been a difficult thing to articulate because, for sure, particularly if you've got a spectrum and you haven't thought about this before, it's not like overnight you can have a switch and you can suddenly adhere to these principles. They require actually thoughtful implementation. As Tushar just said, you've got to integrate it into the way you do things. It's not as simple as saying, well, we've got some energy savings lights, so we're now environmentally responsible, or we adhere to social principles, but we actually don't have a diversity committee, or we have good governance, but actually our board isn't set up that way. You realize that holistically it becomes something that requires you to look at different areas of your business and bring those together. But we're now several years down the track, and what are the trends I see? Well, the practical reality is that in each of these sectors, there has been progress, even if we're not pulling it under the ESG banner. So if you talk about governance, auditors, shareholders, other stakeholders have for years been saying we need this type of governance, we need more transparency, we need better understanding of how boards are composed, we need better understanding of how decisions are made, actually that fits into the governance. It just was happening separately and not under the ESG umbrella, but it's happening. We talk about social, we talk about sustainable. Actually, that is happening as well. Why is it happening? Well, it's not happening because it became cheaper. Yeah, I don't believe that's actually the case. And it's not happening necessarily because monetarily people can prove that if you're a company that adheres to environmental standards, your cost of funding will be cheaper. But what has happened is that regulators, politicians, and investors join this bandwagon. You have three easy trends that you can see. In the European markets, European regulators have now, or politicians, excuse me, have agreed an EU-wide regulation for an EU taxonomy on ESG. Once that happens, it's what I call the Big Bang. And I think if we have this talk 5 years from now, we will look at this summer, not only as a COVID summer, but as the Big Bang in ESG, because unbeknownst to all of us, it all happened quietly in the background. They finally, after 3 years of fighting about it, passed the taxonomy regulation. And that regulation now needs to be implemented on an EU-wide specific basis. And any company within each of those countries will now have to adhere to that taxonomy. That means all of a sudden, everybody has to think about ESG. And you could say, well, what does that have to do with the Middle East? We're not there. We didn't pass that regulation. That's true. But the arranging banks for many transactions do. So they will be asked this question. The pension funds, the investment funds who are regulated in those jurisdictions, they will ask these questions when they make inward investment, either on debt or equity. And finally, from the perspective of just good global participation as citizens, we know that the GCC governments look carefully at what other governments are doing globally, and they never want to be last in class. They often want to be first in class. And this will actually make them sit up and take notice. So for me, that's what I see. I see a very, very slow, thin, opening the door, and suddenly in the last couple of years, a big bang. But it's not a big bang because of monetary pressure. It's actually a big bang because of political and regulatory pressure. Thanks, Jessica.
Yes, I agree. And it's interesting because I've spent many years in Asia, in China and Hong Kong, and seeing how quickly the movement, once the Chinese government and the regulators got behind it with definitions as well, I can see that, there's a lot of similarities with what may happen here. And so to you, Hafiz, you're based in Asia and with the World Bank, perhaps you can give your perspective on what you've seen in terms of the last couple of years as well.
Thanks, Jessica. I think like you and Debashi and Tusha already clearly explained what is ESG and sustainable finance. I believe most of all of the countries are currently prioritize their financings to align with the commitments under the UN Sustainable Development Goal, as well as the Paris Climate Agreements, where they signed in 2015. So based on the UN report that $5 to $7 trillion investment are needed annually to implement this sustainable development goal in 2030. This is where the private sector has a significant role to play in achieving this goal. Let me further explain a little bit about the World Bank initiative in deepening the sustainable finance market, because I'm not going to go on the definition, because I think like Debashi, you and Tusha already clearly explain what is ESG and sustainable finance. So in terms angle from the institutional investor, we also support Japan government pension funds in developing a ESG framework. I think currently Japan is the 4th largest ESG markets. So we also collaborate with the financial regulators and banking association through our IFC, our partner, IFC Sustainable Banking Network. There are 38 members countries already partner in the Sustainable Banking Networks, which represent 43 trillions of the total banking assets in emerging markets. We also work closely with the NGFS, the Network Greening Financial System, a group of the central bankers, I think led by the Bank of England, Paris. So this is a group of the central bankers. They want to push on the climate change, mainstreaming the climate change agenda in the banking institutions. We also, if you look at the World Bank, we also among the issuer of the green bond. So I think like since 2008, we issue almost I think almost like $30 billion in the green bond through more than 150 transactions in 20 currency. We also issue several instruments such as the SDG linked bonds, development impact bond, and so forth, which in line with the sustainable finance. So we also align World Bank our financings and investment with SDG and ESG. In December 2018, the World Bank Group announced a new set of climate target for 2021 to 2025, doubling its current 5-year investments to around $200 billion in support for countries to take ambitious climate actions. And then finally, we also work closely with the developing a green certifier, like for green bond market, they need as external parties, even like a lot of rating agencies now joining as need to provide this kind of service. So this is a part of our initiative in working globally in deepening the sustainable finance market. Specifically for Malaysia, we also work closely with central bank in developing a climate change taxonomy, because like you mentioned about EU, and then even under the ASEAN, we have the ASEAN Capital Market Forum. For Malaysia, we work closely with the central bank in developing a climate change taxonomy, as well as in developing a sectoral guidance for value-based intimidation. They call SVBI, which embedded the ESG for financial institution, where the central bank when all the financial institutions to start adopting the 3P they call planet, people, and profits in balancing for these three bottom line. So I think let me stop here for now.
Okay, thank you. And I'm actually going to stay with you, Hafiz, because I'd be interested, given all that's happened in 2020, how are you seeing these events affecting the sustainable finance and ESG pathway? Have you experienced any change of priorities, or are organizations like the World Bank still on track?
Okay, so actually 2020 was lining up to be a big year for climate actions. So if you're aware about the Climate Paris Agreement since 2015, so this marked the 5-year point at which countries were to step up their climate ambitions. The global climate meeting has now been postponed to 2021 as countries respond to the immediate health and financial crisis posed by the coronavirus pandemic. As health concern lessen, however, countries will need to focus on stimulus package to stem the economic impact of COVID-19. As they do, it will be vitally important to help them build the foundation for a more resilient, sustainable, and prosperous future. So to respond to the crisis, we don't need to restart from scratch. We can use the project already identified in countries nationally, they call as NDC, nationally determined contribution. So this is how we can align the countries' NDC. I believe all the 166 countries, they have their own NDC, their commitments under the Paris Agreement. This is how we need to work they need to readjust to align with the current pandemic, as well as to achieve the UN Paris, the Climate Paris Agreement and the UN SDG.
Yeah. Tushar, can I turn to you now with the same question, but thinking about the context of the MENA region, do you see, obviously, and then the oil price plays in here as well, do you see priorities changing in terms of sustainable finance here in MENA? Oh, I think you might be on mute.
Sorry about that.
No problem.
Yes, indeed. I think, as you mentioned, the oil price, the low oil price environment, coupled with regulatory factors, as Debashish mentioned, will obviously channelize more finance and more sustainable finance. And I think it is important as the regional economies start to diversify away from a resource-based economy into a more diversified and having more resilient a more resilient ecosystem with that diversification. It's inevitable that that more sustainable and sustainable driven finance is actually channelized to fund these projects and to build that infrastructure that is required. That is essential. And I mean, if you look at the areas where, say, the UAE government is focusing, like food security, a lot of focus is being put into that, and finance and innovative structures are being created to actually attract the finance into these important sectors. Also, I must say that alongside kind of public financing, technology driving and startups actually driving innovation in some of these sectors is going to be a very critical driver across the board. And you've seen it in more developed economies. Out here in the MENA region, it is a nascent ecosystem, but increasingly becoming more vibrant. And you see innovative startups coming in and actually changing the whole landscape and contributing towards that diversification effort.
Yeah, Debashis, would you agree? Would you agree with Tushar's comments?
Well, I'm not disagreeing in the sense that I agree that there are those developments that he's mentioning. But what I would say, at least in my personal view, is that the development broadly in other areas of ESG is very nascent in the GCC. And I think there are a number of driving factors about that. First of all, if you think about the composition of public-private, it's very, very difficult to describe that accurately. We talk about private companies, but leaving aside, some selected specific companies where we know that they're listed and we know who the key stakeholders of those companies are, a lot of companies in this region are government sector related in some way. When you trace the majority ownership of financial institutions or enterprises not even related to oil, they're linked back to the government. That means that questions of governance, questions of diversity policies, questions of environmental sustainability policies are actually driven by whether the government itself has yet come to its own decision on how it wants to implement that. And I would say that, again, in my personal view, that we are a long way from seeing that change as of yet. And that's not because, as Tushar says, that there aren't needs. There are needs, and there are definitely some private sector participants who are doing that. And there are some government champions who you can specifically say, yes, but we've seen, government champions championing sustainable energy consumption or environmentally friendly, projects. That's fine, but those are visible manifestations of sectors that they're expanding into. That's not the same as saying somebody has a holistic ESG policy for a major oil company in the region. I would say that we're not there yet. They're thinking about it, but they don't have the same drivers because, again, they don't have a series of pension funds saying, gosh, this is something we really need to get a grips on. We're an institutional investor. What are you doing about this? We don't have politicians within a government who, for publicity reasons, are saying, this is a major issue for my voters. What are we going to do about this? I'm not saying that we need those things. What I'm just saying is that those were catalysts for change in other jurisdictions. Now, in this jurisdiction, we don't have those catalysts. So what we need are people at the policy level of governments who listen to people like the World Bank and the UN, and they look why this is important and whether they want to participate in it. And if they do, we will have change within a small amount of years. Just imagine, in a theoretical example, we have one major Middle East economy and the government says, oh, within a year, I would like, I don't know, let's say 20% of our, our companies where we hold major sectors, which would be a huge percentage, but just say 20%, to actually visibly implement ESG policies so that we would actually have some reporting on it. Because right now there isn't any. If you try and look anywhere where I would challenge you to find visible reporting on ESG compliance on lots of companies that are government sector connected. And the answer is, overnight, you would have a massive transformation because it's the same policy people who could drive that. It's no different than the other things that they've championed over the years. And they've been very good at implementing those things quickly when they want to, but it requires almost some focus on it first. Tushar mentioned food security. That was something that they focused on a few years back, and look how rapidly they implemented that. that. But again, from where I sit, we're just on the cusp of doing it. And it's not because people aren't conscious of it. It's just the nature of the Middle East is more complex on the public-private divide.
Thank you. And I think you mentioned the importance of the pension funds engaging in this, and Hafiz mentioned the Japanese pension fund, GIF. And certainly what we saw there in Asia was when the Japanese pension fund engaged, because of the size and being at sort of the asset owner level at the top of the food chain, it really did ripple all the way through the whole financial markets and all the different players. And I think the critical thing is to get those asset owners on board, because they're the ones who set the standards and the tone and
yeah.
the requirements.
And so the asset owner in the GCC is typically the government.
Yeah.
You know, however you want to describe that. It could be a fund, it could be you know, a direct government ownership, etc. But you just have to look. That's the asset owner. So if you want to label them as similar to the Japanese pension fund, if they say this is important to them, it will happen.
Yeah. And actually, so I'm just going to stay with you, Debashis, because we've had a question from the audience, because I think it leads on. Do you think that ESG in the MENA region is on its way to become mandatory for listed companies? Now, I presume that means reporting, and then obviously the ESG processes that sit underneath that. Do you have any thoughts on that?
Well, I think we're back to that complexity of, I don't think it can be mandatory per se, but I think it could be the case that those investors who can buy into listed companies will actually ask for reporting for at least you know, how you're performing. So again, listing is a complex question. So there are some genuinely listed, well, you know, fairly diversely held companies in the region. But again, a lot of companies that list are actually majority owned from a, you know, again, key government stakeholder point of view. But it could be the case that where you have a company that is listed, say even 30 to 40% of its shares, and therefore you may have a combination of family offices buying in, or regional funds or international funds buying in, they may say, look, what we would like is actually we need to tell our investors about our ESG compliance. You have to help us because you have to publish something that tells us how you're performing against ESG measurements. And those measurements are easily attainable. I mean, there are dozens of outside providers of those metrics now. Even auditors are willing to, as part of their annual audit, provide, you know, information that allows us to understand how you better comply with it. Now, does a regulator overnight implement that? Certainly in Europe, for instance, we know that stock exchanges and financial regulators have asked for disclosure on these principles. I think it can't necessarily be driven that way. I don't think you can have, for instance, a stock exchange locally suddenly say, please report on ESG, because I think the issue would be in what way, you know, to whose measurements are you using? Jessica, you mentioned China. China's green standards and the explosion in green bond issuance was not driven by implementing a standard out of the EU. China implemented their own standards. Now, I have my views as to how green they are, but they still drove a market. They still drove an initiative by creating their own standards. So yeah. I think the way I imagine that the GCC would work is that they would have to be some collaboration between a regulator saying, okay, I think we can do this, but let's talk about what's achievable in the first 5 years of doing this. And what would investors like in terms of reporting? Most investors, frankly, just want transparency. It's up to them if they want to invest. So if a company says, I don't have any standards, okay, that's fine. As long as they're telling us that, it's up to an investor whether they want to invest or not. It's not something that is forbidden.
Yeah, and I think that point about China and its taxonomy is very critical, because it certainly did get the market moving, but there are obviously deep questions around what's eligible and what's not. And I also think that's potentially something in the GCC we need to consider in terms of transition risks. Tushar, you mentioned sustainability reporting that you've been doing, and also the importance of data. What do you think in terms of ESG in the MENA region, if it's on its way to become mandatory?
Yeah, so I mean, if I may, I completely agree with Debashis. We're still at a very early stage, and there's a long way to go. What I mentioned was, I think the low oil price environment and pandemics like this will accelerate the pace of change in the MENA region with respect to ESG, because the need and the imperative is only enhanced. I do think obviously regulation is important and has accelerated things and catalyzed things in other geographies around the world. But alongside regulation, I think it's really the business imperative. There is a business case, and companies are realizing that, realizing that more and more because of the change in consumer behavior. So regulation is useful, and creating regulatory frameworks and making disclosures mandatory are important in a phased way. But I think what would really drive change and real change is businesses coming to the realization, which they have already, that it's no more just a ticking the box exercise. It's important for the business itself to be sustainable, and for all stakeholders involved to actually realize that. So with respect to reporting, and again, in the region, it's a very different mix, as Debashish pointed out, in terms of, government being asset owners and government being across sectors. You have family businesses, which are the backbone of regional economies, who are largely unlisted. So having regulation that makes listed companies disclosures mandatory, I don't think is going to solve the problem. It has to be other standards which are created across private sector, maybe starting with the larger companies to start reporting and set standards and benchmarks in terms of what reporting. Again, and ourselves, when we first started reporting 8 years ago and our reports today, there's a huge change in terms of how you report. So what would be helpful is setting those benchmarks and standards on how companies should report and why it's beneficial for companies to report. Coming back again to the business imperative, that I think would be more meaningful change as opposed to just imposing regulation.
Yeah, and I think one thing that's now being recognized internationally is the proliferation of so many standards and reporting frameworks, and how do we bring those together so there is consistency across the board? Because from the investor perspective, that can be very challenging. So Hafiz, I'm going to turn to you now. Sorry.
On the data point, which is very important, as an investor, you're able to make a more informed decision today because of the data, because of the enhanced reporting over the years. You have much more meaningful standard benchmarks to compare one company to the other. So as this grows and as data becomes more standardized and more available, it'll only push companies to do more.
Yeah, I agree. So Hafiz, just on this theme, based on your experience with the World Bank, what role do you think governments and regulators should be playing? And where you've obviously seen positive developments in the ASEAN region, are there lessons that we can learn from this in MENA and in the UAE?
Thanks, Jessica. So I think like Debashish also mentioned about the standard, the EU taxonomy. So I think for ASEAN country, we have 10 ASEAN countries. So to push for the same standards, so it also take a challenge. However, with the strong commitment from all the capital market regulators, so they managed to issue 3 standards: green, social, and sustainability bond standards. So the idea to have this standard to help the country involved implement their commitment first under the Paris Agreement as well as the SDG, and also push for a standardized set of rules for green, social, and sustainable bond across ASEAN member countries. So indirectly, it will help intend to enhance the transparency for issuer. Like we mentioned, we discussed about transparency of green, social, or sustainable bond, reduce due diligence costs, and help investor make informed decision. That's the idea for 10 ASEAN countries to have the same standard. So at least for investors who are not familiar with the ASEAN region market, so at least if they issue under this umbrella, so more convenience to the investors to buy the bond in that region. So that's the benefit, the beauty of to have a standardized among the region. Because I think previously, like ICMA, the International Capital Market Association, also issue a green bond, social bond principle at the broad level. But because the ASEAN, they have because they said they cannot match that standard, so they tailor a little bit for the ASEAN region. So that's the idea, they come up with their own standards, but in line with the ICMA principle.
Yeah,
I think that's an incredibly important point. We have to keep returning to that, because I think people then become alarmed saying, oh, well, you know, they'll water down the standards, they'll do this, they'll do that. They may, you know, they may, but remember, everything always starts with an ideal, right? And the reality is that we still have to implement that. It's, you know, and so it's important to take the first step. And I think people become too cynical and say, oh, well, we've implemented some standard and it's not good enough. Well, it may or may not be, but we have to acknowledge that parts of the world are at different stages of their own economy. They're in, say, different stages of diversity of the workforce. They might be in different stages of gender diversity, of, you know, board composition. I think it's important that all these things do come into line, but you have to start somewhere. And to immediately implement a standard from some other, you know, region where they may have been working at it longer on a new economy region is a challenge. I still believe that the fastest way to move this in the Middle East is not necessarily a regulation per se, though I'm not against it. It's more that I think it would only take one or two government champions to say, this is important to me. So just imagine you have a major sovereign wealth fund that's a domestic sovereign wealth fund. And we know, we don't need to name them, but there are a number of funds active in the region that hold large stakes in government champions in the region. So I'm going to leave aside the family offices for a minute, because that's a more complex area. As Tushar said, they're largely private, and, you know, whether there's regulation or not, they're private. So, you know, the only thing that will change them is whether their debt providers have particular requirements, you know, and that's a more complex question. But imagine that one of these funds, which is domestic, but ultimately uses, you know, what are the people's money to invest in and in its holdings, says, you know what, I hold stakes in major airlines, and I would like better transparency from those airlines for me along these principles, and I'm going to lift from ESG principles and other areas, and I think I need to know these things. Now, that actually has a transformation effect, because all of a sudden you create a system of people talking about this, understanding it, implementing it. They talk to others, and before you know it, it becomes spread across the region, because this fund will say, well, I want to do that too. Also, you educate stakeholders within the companies who think it's important. They often work across boards, so you have common board of directors, and all of this, it becomes a self-fulfilling cycle. I think that, to me, is the catalyst for change. You know, we can implement regulation all we want, but unless somebody who's an asset owner says, I'm really interested in this, I don't see it changing dramatically. And that to me is the major thing I think we need here.
And I agree. I think we've seen the evidence. Obviously, if you start at the top of the food chain, you know, which is the big asset owners, and how that goes through the entire process, it's really critical. And we've seen that in the US, we've seen that in Europe, and we've also seen that in Asia. Just thinking now in terms of the context of 2020 and COVID, I just want to touch on the issue of climate change and the environment, because obviously this region faces some significant challenges. And we need to think through how do we facilitate that clean energy transition. Tushar, I would be grateful for your thoughts in terms of what you think needs to happen, both on the investor and the company side, to really leverage that transition and to understand the opportunities. Before you answer that, can I encourage anybody from the audience who wants to send in any questions, please do. We have 11 minutes left, so I'd like to address any questions you might have, so please do send them in. Tushar, any thoughts on the climate change challenge in MENA?
Sure. So more broadly, I think globally, again, we've been talking about climate change for many years. It's obviously, it becomes and has become a really hot topic of late. But again, it's inevitable, and it's a business imperative for every company to actually go about thinking and doing something on it. I mean, there was a report from Stanford, I think late last year, which said it'll cost $73 trillion to move from fossil fuels and into cleaner energy, but it can pay for itself in 7 years. So the benefits of climate change, be it reduced energy costs, be it enhanced jobs, be it reduced healthcare costs, all of that, looking holistically, it's absolutely necessary. Coming to the region, of course, again, there is and a lot has been done with the nuclear program, with the solar developments and initiatives, but obviously much more needs to be done. And again, it has to be a concerted effort from both public, government, quasi-government entities, and the private sector. Where, again, if you talk about reporting and data, and I was reading a report where over 60% of the Fortune 500, they do report on their emissions, but only about 12% of them report on how they're using renewable sources of energy within their operations. So it has to be looked at from a broader kind of lens and a more holistic lens, not just ticking the box and reporting on emissions and trying to bring down emissions. That's important, but also using renewable sources of energy within their operations to actually drive more meaningful change. And that's critically important in the region as well.
I'm going to throw in a one thought and sort of a question. Do you think there's a need for a global carbon price to make that transition happen more quickly? Open floor.
So I'm a big believer in that. So I think as somebody, I don't necessarily want everything I do to become more expensive, but I do believe that would be a better way of pricing consumption. So if we think about the Middle East, for instance, it's a bit of a perverse effect, but the reality is low oil prices actually will help or almost incentivize you to consume more carbon. Because if you think about it, filling my big SUV at the petrol pump is going to become cheaper. Running my air conditioning units at the house, in theory, could be cheaper. And for governments, what is the most expensive element of extraction for them in the region is actually desalination. That's where a huge amount of energy consumption is, because it's water supply, it's not oil. And so for me, it's very difficult to incentivize people to move to clean energy, because we don't have the cost factors we might have in other regions where oil supply is actually, even at low oil prices, it's still expensive. So you take the example of India, which is a huge importer of oil. You can start to price the cost of oil, relative to what the market demand is. While in this region, the GCC, you don't. However, carbon, you could. So for instance, if it becomes the case that desalination puts a huge carbon footprint into the air, and the parties that own the desalination plants say, look, this is the true cost of our water because of the carbon cost. And we may subsidize some of this because we can't have all our people not afford to have water. The reality is we start to think more clearly at the consumer, government, and business level about what the cost of these things are. Not just purely oil price, but actually, what does this cost me to consume it? So if I fill up my SUV versus my small car, what does the carbon footprint of these two things mean relatively to my cost benefit? I still may want the giant SUV, but I need to know that it costs more to run it, not from an oil point of view, but from a carbon footprint point of view. I think if you scale that up to an airline or to a massive enterprise, it becomes a realistic discussion about how to truly price these properly. And then it becomes an investor discussion. And then it also becomes an ESG policy point of view, because the board of directors says, gosh, this carbon thing is costing us a lot. What are we doing about that? You know, and then it becomes a proper discussion about pricing, rather than just saying, well, oil's really cheap, so maybe we'll do solar, maybe we won't.
As an economist, I wholeheartedly agree with you. I'm conscious of time. We only have 5 minutes left, so I'm just going to ask a question to each of you. Just keep an eye on the clock, of course. So looking beyond 2020, what do you feel is the future for sustainable finance? You know, thinking both from an investor and a corporate perspective, what are the big worries? But also, what do you see as the big, exciting opportunities, maybe 5 years' time, 10 years' time? Hafiz, can I start with you, please?
Yeah, I think it's a clearly mentioned about, you know, the global efforts, you know, like UNPRI, and then under the central bank group, NGFS, and then from the insurance perspective, they have the, you know, from the insurance, and then from the banking sectors, UN. So all the financial sectors, all the angle of financial sector, they push for ESG. So by hook or by crook, you have no choice. So if you're not adopt, you're not aligned with this ESG, at the end of the day, you will left behind. So like Debashi mentioned, you know, moving forward, this will become a new normal, you know. So this is something that I think the private sector especially need to quickly adopt, if not, you know, when we're talking about the international trade. So when the EU start impose or EU taxonomy, I think even one company, even in Asia, happened when they export the mask. So because they not comply with the social part, so the US and UK reject the product. So this is the implication when you would not adopt the ESG at the global stage.
Okay.
Thank you.
Thank you. Tusha, I'm turning to you now. Just your brief perspective on that.
Yeah, I think, I mean, with all these global initiatives, I completely agree. I think what's most exciting, or what I would look forward on, I see happening is the role of technology, again, in shaping all of this and accelerating all of this, where you have regulation, you have all of that, but these new innovative, transformative startups coming up and actually just changing the status quo and changing the landscape out there, where larger, I wouldn't say irresponsible, but larger incumbents are forced to think differently and actually do things in a more cleaner and responsible way. So I think technology and innovative companies coming and changing the game is something that I see happening in the next 5 to 10 years.
Yes, absolutely. And Debashis, to you now.
Well, I guess very quickly, I'll start with my worry first. My worry is that, you know, the global COVID pandemic has set back economic growth significantly, and I think all governments will be under pressure to help regrow economies and businesses, and that may mean a relaxing of certain implementation of standards or a delay, simply because people will be able to say to them, don't do this now, I'm just barely surviving as businesses, you know, and that's from the smallest business to the biggest business. So I think we may see a delay in sort of the government implementation of things. That being said, I go back to what I said before. I think summer 2020 was the big bang in EU. I think that will have a global impact. I'm not saying that the EU is a champion. I'm just saying the fact that they've agreed it across so many countries and now will implement it will have a ripple effect globally. And I think that's a great thing.
Yeah. And I think, and as you know, I think one of the key takeaways is the pandemic and all that's happened this year really gives us that opportunity to ask some fundamental questions around what does the future look like for businesses, for the private sector, but very importantly, what's the role of the financial industry and how can we play our part in really making this change happen? With that, it's almost the end of the webinar. I just want to say thank you very much to all of you panelists and to everybody listening. And I hope you enjoyed the discussion. Thank you very much.
Thanks very much.
Bye.
Thank you very much. Bye-bye.